Hi guys, my name is James Hayarthur, and I'm the founder of some of the largest credit restoration firms in the nation. The question I have for you is, how do I prove that I'm also the founder of some of the best credit restoration firms in the nation? Shall I talk about the fact that we've serviced over 300,000 clients in the last decade? Shall I talk about the fact that we've had third parties come in and test our numbers, proving that we have a deletion rate of 4.2 deletions per month per client, or the fact that we have a 20-point monthly increase per client per month, and that includes an average client adding on 2.2 derogatory accounts to their file while we're working on them, we still get that 20-point monthly increase. Shall I talk about the fact that we also have a 130% ROI? In fact, I think I will. 130% ROI is what we've been proven to deliver back to our clients. That's return on investment. Now, if you don't know much about investing, a great interest rate could be 5 or 7 or 10%. You know, if you can get all the way up to 15%, heck, I'd beg, borrow, and steal what I could to try to invest in something like that. 15% return on your money, that'd be great. We return 130% back to our clients on what they provide to us for our services. 130% compounded annually. That's an enormous sum of money over time. If you can think about, you know, maybe if you had a stock or a bond or a CD and you're getting that, once again, that 7%, which is pretty standard over time, 130%. How do we derive at 130%? How do we get to that number? Well, I'm going to explain that to you because it's very, very important. First of all, one of the main areas that we focus on is in the housing market. Nothing more important than getting it into our home. That's where our primary niche is focused on, because it's one of the biggest values we can provide back to the client. If you can't get qualified for a home due to your credit scores, that there is no more important things to fix than your credit in order to get into that house. There's a few guarantees in life. You've heard of death and taxes, right? But I also can guarantee inflation over time. I can also guarantee asset appreciation over time as well. Asset appreciation, such as something like a home. 50 years ago, average home loan was $20,000. I think average home price, $20,000. Today, $320,000. Assuming the same rate of inflation over the next 50 years, it's going to be $5.1 million. That's an enormous sum of money. You know, right now, I believe 70% of the millionaires in the country right now are a millionaire due to the fact of their home. 90% of America's wealth is in real estate. So something we can't ignore. So if you're going to be living for the next 50 years, you want to be participating in some of that 5.1 or all of it, $5.1 million. If you're not going to be living for another 50 years and don't plan on it, it's okay, because you'll still get a large portion of that money. I don't know if house prices are going to go up next year or the year after that, but I do know over time, over a long time, that will occur. That's been proven over and over again since the caveman days. So one of the biggest areas that we focus on is making sure we can do whatever it takes to try to get people qualified with their credit scores for a home loan. But it goes a lot beyond that as well. And that goes back to the ROI of 130%. What other areas in life are you really saving money on? Let's take a look at something that's also related to the housing market, such as PMI. A lot of people don't even know what that is. PMI, private mortgage insurance. It's something you have to get if you can't get 20% down on your home. And you have, let's say, at least a 640. But at a 640 credit score, which isn't that bad at all, especially if you're using a FICO algorithm to calculate it, 640 credit score is going to cost you around $5,000 more a year on an average home loan with $300,000 than someone with a perfect credit score. $300,000 loan, you spend $5,000 more a year on PMI. Even if you have a very good credit score, as good as a 729 FICO score, you're still spending around $81 more a month than someone with a perfect credit score for PMI. And that's more than our services are. So it's crazy sums of money. Another one would be auto insurance, something people just, you know, overlook all the time. But if you have a weak credit score, you're going to spend about $1,300 more a year than someone with a perfect credit score. And even if you have a good credit score, you're going to spend more, like $50 to $500 more a year than someone with a perfect score. And a lot of people come to me all the time and say, you know, I don't need this. My credit score is pretty good. My score is very good. Very good, pretty good, doesn't matter. Unless it's perfect, the amount of money you're wasting is insane over a lifetime, because you can add in things like time value of money. time value of money is a very, very important concept. It means if I had my money today and I could put it somewhere, what would it grow? What will it grow to? Warren Buffett said it best: the most powerful force in the universe is compounded interest, and it's absolutely true. Time value of money goes into that greatly. So, for example, in the auto insurance example, if I have a low credit score and I'm spending $1,300 more a year on it than someone with a perfect score, insuring exactly the same car, okay, over time, if I had that money, I could invest it and maybe get a 7% rate of return on my money, which is pretty standard. Putting it in a retirement account or something like that. Over time, over a lifetime, that's going to equate to about $80,000. Take an auto loan example for. Average auto loan right now is $30,000 for a new car purchase. That means if you have a very good credit score, 720 or above, I believe, and interest rates vary all the time. So the time I've given this message, they could have changed slightly. But average interest rate roughly right now is 3.6% if you have a 720 or better. If you have a 640 or less, your average interest rate is at 620 or less. Average interest rate is going to be 15.24%. Okay, 15.24 on one side, 3.6 on the other. The difference between those two on that average auto loan of $30,000 is $10,800. Is how much a person with a lower score, not the worst score, a lower score, spends compared to a person with a perfect credit score. Okay, $10,800. That's the same car, guys. It's not like it's a faster car, a better car. It's not a better color. It's exactly the same car, except person A spends $10,800 more on it than person B due to their credit score. Now, if person B took that $10,800 of savings and applied it into a retirement account and let it sit there and earn 7% rate of return on their money over the next 30 years, that's going to turn into $80,000. And our studies show that someone with a low credit score over 30 years on all the vehicles that they're going to purchase, which is an average of 2.2 at any given time, is going to get to about $500,000 in losses on the same cars over 30 years than somebody else. $500,000. Now translate that back to how many years of work are you going to go and work for in order to pay the difference back of $500,000 over a 30-year time frame? Add your insurance in, your PMI. You could add your interest rates on your home loan. If you're a homeowner and your credit score is subpar, you're going to spend a heck of a lot more on interest rates on a monthly basis than someone with a perfect credit score. It's about, for every 20 points, it's roughly around a quarter point interest. And that over a 30-year mortgage, that's a pretty penny and a half. Another example, maybe credit cards. We all know that they can be outrageous. I think according to creditcards.com, last time I looked, average interest rate with someone with a subpar credit score was at 23.23%, including store cards. 23.23% interest. That means if you spend $1,000 on your credit cards and you pay the minimum amount, you're going to pay $800 in total interest, and it's going to take you 6 years to pay it off. $800 in total interest. If you have a perfect credit score, you end up paying a total of $200 in interest, and you'll pay it off, I believe, 2 years earlier. That's a $600 difference per $1,000 you spend on your credit cards. Now add up all the many, many thousands that you'll be spending in a lifetime, and that can be an absurd amount of money. You could easily get into the $1 million category or amount spent, wasted in that category. Add that to all the other categories we just spent. We estimate average person could easily be around $1.7 million in wasted money just due to their credit score on these interest rates. And that's not even including the benefit of getting in something like a home loan, okay, if that's the ultimate goal. Because a home loan, once again, over the next 50 years, could easily provide $5 million worth of equity. Add that $5 million to the 1.7 lost year, somewhere around $6-7 million that your credit can provide to you or save you over a lifetime. An absurd amount of money, and it's something that is absolutely necessary. In my personal opinion, your credit scores are the best and most important investment of your life. It's your foundation of your financial freedom. There is nothing more important, and it doesn't matter if your credit score is poor, if it's terrible, if it's fair, if it's good, if it's very good, if it's not perfect. You need to put all efforts in trying to get it fixed, and that's what we do here. our entire focus is try to increase the credit scores as high as possible, as quickly as possible, to be able to pass these savings on to the clients. And I'm very proud of what I do, and I really do hope you join us. A little bit about what we do and how we do it. First of all, we go through an investigation verification process to really sink our teeth into anything the clients find questionable, erroneous, non-verifiable, misleading, obsolete in any way. We're going to go in there, sink our teeth into those accounts, and ask for the bureaus and the creditors for a series of information regarding those accounts. First of all, we're going to make sure that there's not just a blatant surface error on the credit report. We see surface errors all over the place. That's going to be code errors. That's going to be anytime you see missing information, you see dashes and slashes on a credit report. It's going to go into the times that you may see the words unknown, or the times that you see like just where it has like medical collection, doesn't even say who it is, it's missing the original creditor information. You may have dates that are incorrect, all of those kind of service errors. The next step we go through this investigation verification process is creating investigations to have the validity of the account verified. So in other words, can they provide all the information regarding the accounts? Can they provide A, B, and C? If the client's finding this account questionable, they're not sure it's theirs, they're not sure it's reporting correctly, once again, you provide each one of these areas. And that step 3 is going to be the 30-day time frame. Can they complete all the tasks that we're handing them in 30 days? If they can't, by law, once again, it does need to be removed off the credit report. And lastly, we find that a lot of times an economic decision's made. A lot of times the creditors do not want to go to battle with us. They do not want to verify the information because economically they may have already been paid for the account. 30% of items on a credit report have already been satisfied. And whether it's accurate or not accurate, the creditor just simply does not want to engage with the client. And that's their choice. That's their right. We have the right to investigate the accounts to find out if they're accurate. They have the right to not respond if they don't want to. And a lot of the times we do find out that is the actual case. Right or wrong, that's their choice. And so whether it's a $1,000 medical collection that gets sold on the open market for 2 cents on the dollar, you've got to figure at some point in time they need to decide, is it worth verifying this account, or if they've been paid for the account, so on and so forth. So we go through the detailed investigation and verification process. That's how we end up with that 4.2 deletions per month. And one of the reasons why we also get the 20 points increase in the month, but not the only reason. One of the largest parts of our program is also maximizing the client's positive credit, making sure they've got enough good credit on the report to sustain the score they're looking for. There is no point getting all of the derogatory, inaccurate information removed off the credit report, only to find out at the end of the day there's just not enough good credit to get the score where it needs to be in the first place. So we're going to do a scrub of the algorithm to really make sure the client has everything they need. We're going to break it down, and credit scores are like a thumbprint. Everybody's situation is different, so what applies to one person certainly may not apply to the other. But we're going to take a look at payment history, amounts owed, new credit. We're going to take a look at types of credit being used. We're going to take a look at revolving debt utilization. Should someone get a credit card? If they are going to get a credit card, how should they use it? The ones that they do have, how much should they use the ones? How much should they be paying them down? Should we get a student loan out of deferment? Should we pay an account off? Should we close an account down? Should we get multiple accounts on one certain category? There is so many areas to work on improving the algorithm, and the algorithms are very, very complicated. And a lot of times what people think will help is actually the opposite. A lot of times we get clients that say, oh, the first thing I want to do to improve my credit score is I'm going to pay off this medical collection, for example. It's been on my credit report for 5 years, it's $50, I'm going to take care of that. Most likely that will lower your score because it renews your date of activity. And that is what counts as the weight on your credit report. So these are the kind of advice. We don't want clients throwing away money on areas of their credit report that isn't going to help them. So we'll give them the right advice within the means that they have available. No point giving them advice of things that they can't afford to do either. Okay, so it's going to be within their means, instructions today, instructions tomorrow, next week, next month, so on and so forth, so we can consistently get at least that average of 20-point monthly increase. That's the plan. Of course, it is an average. Some scores will go up a few points. Some scores will go up a whole ton of points. There's a variety of, that's how you get to an average. But at the end of the day, it's a very consistent number that we believe in, and we certainly hope you'll join us once again. Whether you're a mortgage professional in the market looking to try to help one of your clients close a loan, that's what we specialize in, or if you're the client themselves just looking to refinance, get a new purchase, or just improve your credit scores for a future date, please come and see me. I much appreciate it. Thank you very much and have a great day.